Hello, and welcome to the latest Expert Series webinar. Today's is Rethinking the Core, an intelligent approach to risk management. This is a complimentary IndexUniverse webinar courtesy of Vidant Financial. I'm Ollie Ludwig, the managing editor of IndexUniverse. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference, which will be happening later this month in Florida. Joining me today are Nick Stonestreet, co-founder and CEO of Vidant Financial. He was formerly Executive Vice President of Regions Private Wealth Management, and he was responsible for providing comprehensive planning, investments, and banking solutions for affluent clients. Regions is a nationally recognized bank holding company headquartered in Birmingham, Alabama. Ted Lucas is also with us. He is the founder and managing partner of Lattice Strategies, an investment firm focused on risk management and based in San Francisco. He's also joined by a colleague, Mark Thomas, managing director at Lattice with responsibility for developing strategic relationships and helping lead Lattice's client solution and product strategies. Before we get started, I'd like everyone to know that you can ask questions at any time during the webinar in the window at the lower right of your screens. I'll also be chiming in from time to time with some questions along the way, and there will be a Q&A at the end. So please listen carefully and feel free to ask as many questions as you'd like. Today's webinar takes us to a very exciting crossroads in the world of indexing and the world of exchange-traded funds. My guests from San Francisco-based Lattice will be speaking about their expertise in risk management and in risk-weighted portfolio construction. That's an idea we've been hearing a lot about in the ETF traffic in recent years, and with a partner like Vidant Financial, we'll be hearing a lot more about it for sure. Vidant may need an introduction today. After all, it came onto the scene just a few months ago, and it's without question the single most successful newcomer to the world of ETFs in recent years. Vidant, for the record, means to oversee in Latin, and we'll get to the significance of that in a moment. But to get right to the point, the company's Vidant International Equity Fund, it trades under the symbol VIDI. It came to market at the end of October, and it has already gathered an astonishing $545 million. We can only wonder what its next ETF, the Vidant Core US Equity Fund, which will trade under the symbol VUSE, will gather when it comes out of the chute just a few weeks from now. And as I said a moment ago, Vidant finds itself at an interesting crossroads in the world of money management. And that's to say, it has managed this impressive asset gathering feat in a number of ways. First, it made common cause with Ron Blue and Company. This is an RIA based in Atlanta that steered a significant amount of client assets to Vidant's first strategy. And again, that's more than $500 million since late October. Welcome to the world of what we call bespoken ETFs. This is a relatively new trend in ETFs, wherein investors are lined up before a fund even goes live. And Vidant Financial is clearly one of the leading beneficiaries of this trend. But Vidant's story is more nuanced than that. The funds that it's offering and plans to offer in the future are very much in the realm of what we call enhanced beta, the vibrant pocket of the fund universe pioneered by the likes of Rob Arnott at Wisdom Tree Investments. To put a finer point on it, the indexes Vidant uses, which were developed with Lattice, screen for a number of factors you won't currently find in other available strategies. Within its international strategies, these include factors like growth conditions, monetary policy, economic freedom, and governance. And the U.S. strategy that I said a moment ago will be coming to market within a few weeks considers corporate governance factors such as financial reporting quality, board composition, and other ethically based factors. Those growth and ethical considerations dovetail well with the values of Ron Blue and Company, which has a large clientele, some of which explicitly identify themselves as Christian. Vidant itself is not Christian per se, though there is clearly a meeting of the minds here in terms of values between these two firms. And with all the excesses we witnessed from Wall Street in recent years, this seems like it could be a virtuous partnership. But the devil is in the details when it comes to indexing methodologies and in what Vidant calls, quote-unquote, principles-based investing. So let's get right into it with Nick Stonestreet, the CEO of Georgia-based Vident. Nick.
Thank you, Ali. Thank you for that introduction, and thank you to everyone who's joined the conference. Yes, we're excited to discuss principles-based investing and the construction of the indices that we've released and get into some of those details that you've mentioned, Ali. Today in the agenda, we'll go through an introduction to Vident so you'll know who we are a little bit more, a little bit of an introduction to principles-based investing. We'll talk about some of the traditional problems with risk and how risk is viewed, maybe give a little bit different lens, a different view about risk, and then some solutions, some practical portfolio solutions and investor solutions. And of course, we'll leave time for Q&A at the end. Vidant Financial, as Ali mentioned, it's a Latin word that means Vidant means they oversee, they care for, and we are creating, and we believe in an innovative way, principles-based solutions. One of the key factors with Vidant as well is that our ownership structure is unique. We're owned by the Vidant Investors Oversight Trust, and the ultimate beneficiary of that trust is a charity. So for my job as a CEO on a day-to-day basis, it's great that I don't have a lot of pressure on shareholders that I have to return dividends to, et cetera. It's kind of a structure where we can focus on investors. And this is why when we established Vidant, we gave it away to a trust to make sure that our sole focus is providing the best outcomes for investors. When we talk about principles-based investing, it really is investing with a lens that suggests a greater possibility of goal attainment through adherence to principles. And as we talk more about risk, we'll see how we view risk in a different way, in a different light. As a framework, we want to apply time-tested principles to investment research. We really want to get to the heart of wealth creation, and we think we'll have a robust dialogue around that. We want to utilize principles as a lens for investment and research decision-making, and also we want to do this in a systematic way so that we can avoid the stock picker bias. So we go on, people's question is probably, well, you know, what are some of these principles? And so I'd like to go through a few of them just briefly. One principle is we really believe that applying wisdom gives us a greater chance of outcomes and goal attainment over the long term. And so when we're creating solutions based on wisdom, we really feel like it gives us a long-term focus and allows us to step away from short-term volatility. The principle of uncertainty, I think that our industry is really a reflection of uncertainty in that why do people plan, save, and invest to begin with? They want to be able to accumulate, to hedge against future events that none of us can forecast or foretell. And so we want to create solutions that fit for long-term plans for investors so they can take that excess and they can invest it wisely and they can have it to be a buffer against future uncertainty. Human productivity. For us, there's a pretty simple formula, which is people plus opportunity creates abundance. And so when we think about how wealth is created, we really think about environments that are conducive and factors that are important so that people can be more productive. Lower tax rates, favorable demographics, et cetera. All of the ways that would lead to human flourishing. Leadership and governance. We think this is key. And we all have examples of where leaders have, whether it's in a company or in a country, have created huge value or destroyed huge value by poor leadership and governance practices. And another key factor for us, another key principle, is the principle of inherent value. Really, what is something worth? What should we pay? So we could have an environment with excellent leadership and governance. We could have an environment that's highly productive. But if it's overpriced, it's just not a place where we think it would really align from an investment standpoint for us. And so we have very key kind of valuation metrics in the way we construct the indices. Instability. And this is why you'll see our solutions have a great degree of diversification, even more diversification than cap weighting. And the reason is simply this, that we really don't know what's going to happen, and we've seen instability in 2008. We've seen instability in many other crises throughout the world in different jurisdictions at different times. And so because we don't know and because things can happen quickly, we want to be sure that we have appropriate diversification, and we'll go into that in more detail. But just to give a couple of quick glimpses, this was of kind of principles in practice. This is a Bloomberg Business Week article that was about an Italian factory owner who moved his factory to Poland. And his quote, "The plain truth is that I wanted my business to survive, and there weren't the right conditions for me to operate in Italy any longer." This isn't an anti-Italy slide. It's a pro-productivity slide. It's about capital-seeking environments where that capital will be respected, and that's an important part of our investment thesis. The next slide is self-explanatory, and despite Dennis Rodman's best basketball diplomacy efforts, I still don't see many lights on in the northern part of Korea. Same people, same history, two very different ways that they view capital, view the world, and they're led two very different ways. And so this is a stark contrast that shows the effect of principles in practice.
Nick, can I chime in a quick question, please?
Sure.
Given all the different ways we can access financial markets these days, what's the easy case for why there should be principles-based investing when there are a whole range of choices that, on the surface of it, seem to work perfectly well?
Well, let me, Ted, why don't you jump in here, because I think you've got some good illustrations that could go through that. It's a great question, Ollie. Thank you.
Thanks very much, Nick and Ollie. One of the key ideas in constructing this strategy really was to say, how do we define risk? And most of us participating today who have been schooled in classical finance theory are well acquainted with modern portfolio theory. We've used tools like mean variance optimization to construct portfolios. And really, in that construct, risk is defined as historical price volatility. So whether looking at a stock or whether looking at an individual country or some other asset, volatility is the risk input to, say, a mean variance optimization exercise or in the construct of modern portfolio theory. And coming off 2008, I think underscores the point that historical volatility itself is not necessarily indicative of realized risk over time, nor the attractiveness of an asset. So a real starting point here in constructing this strategy was to say, let's expand the dimensions of risk that we look at. And as Nick was describing before, we believe that there's a number of underlying characteristics when we look at a country that will define its productivity, its future growth, the ability for corporations to be productive and for wealth to be created. So in working through that, we really want to look through much more fundamentally at the country level at things beyond just the stock market volatility historically. So certainly looking at growth both over time and trajectory, and then looking forward, growth differentials. This is an example. This is not to celebrate Singapore or pick on Japan, but just to contrast, for example's sake here, two countries. Growth, very different. Historical growth, forward-looking growth, these are IMF numbers looking out over the next 5 years. And then debt. Singapore actually has a bit more debt than many of its developing markets counterparts in Southeast Asia, but contrasted against the close to 250% public debt in Japan is relatively less indebted. We do believe that debt levels ultimately have an influence on the growth of an economy and private sector productivity. Fiscal discipline of a country's government. Singapore actually is running a surplus in terms of budget balance to GDP, whereas Japan, as we know, undergoing a lot of both fiscal and monetary stimulus, is running a pretty significant deficit. Government spending, this is really the percentage of the overall economy that is taken in by the government and really not available for private investment. So much higher in Japan, in the case of Singapore, much lower. And then we also look at different measures of economic freedom that aren't as precisely quantitatively definable as things like debt deficits and so forth are. And these include things like rule of law, property rights, the regulatory environment, the tax environment, trade openness. These are things that, among other services or organizations that try to establish a way of quantifying this, Heritage Foundation, many of you might be familiar with the Index of Economic Freedom, 2014 version was just released this week, but essentially looks at these different measures of economic freedom. Goldman Sachs publishes a growth environment score for each country that also looks through to infrastructure and other things that engender growth. So the idea here is both countries in this example have very similar price volatility. You put them into an optimizer, they're the same risk. And a light bulb certainly for me personally in all the research that went into developing this strategy was, really, if we look deeper, are they really the same risk? Beyond just looking at the fundamentals of countries, just looking at, for this strategy, an international equity strategy, the concentrations that you would experience either investing in a cap-weighted international equity index and many active strategies that are benchmarked to indices such as the ACWI ex-US, where country deviations are in many cases minimized. And like many cap-weighted indices, there is a significant amount of concentration, particularly in this index, given that you have economies that are much more mature, have a longer history of capital market formation. It's very acute here. So out of the 44 or 45 countries in the ACWI ex-US index, the top 10 countries represent 3/4, perhaps even more illustrative at this point, the top 5 countries, which in rank order are Japan, the UK, France, Switzerland, and Germany, constitute over 50% of the index. So you have very high concentration. As noted with the countries that I mentioned, the concentration tends to be in these more mature economies where you do have, generally speaking, higher levels of debt encumbrances, slower growth, demographic issues, and potentially regression across economic freedom factors. And of course, capitalization-weighted indices are not taking into account valuation, which is a very important discipline in this strategy.
Thanks, Ted. So as Ted pointed out, we look at, if we look at...
Nick, can I ask another question really quickly? I'm sorry to interrupt you.
Yeah, no problem.
I mean, it's interesting what you're saying there, Ted. I don't know who will take this question, but the emerging markets, the developed markets, I mean, it's very much at a crossroads right now. So what is a more appropriate method for allocating capital across both the developed and developing world, the way you guys see it?
Well, as we go through, Ali, and that's, thanks for asking that, because this is one of the key considerations that we had in the construction of VIDI. How do we really apply these principles, and how do we tilt towards environments that are more favorable for growth, but also how do we control the risk associated with that? And, we didn't find cap weighting as the best solution, and we didn't find traditional volatility measures as the best solution. So really, as we develop the core holdings of VIDI, we wanted to develop across both developed and emerging markets and have that principles-based emphasis, and then have that across 65 or 35 countries. So we want favorable growth conditions across 35 countries, and we wanted to do it in a systematic, transparent way. And so I think as Ted goes through, Ali, some of the way that the index is constructed, it'll help answer that question at a deeper level. Ted?
In terms of creating this strategy, as you'll surmise, we've built essentially a rules-based strategy index that attempts to very systematically, very repeatably apply evaluation of these different risk factors and then other methods to reduce concentration that you would find in a traditional international equity strategy. So there's really 3 principal investment layers I'd like to highlight. The first really seeks to address the concentration issue that we just discussed. And when you think about concentration, you really have 2 levels of this to think about. It's not only the country concentration, But when you look within many countries, you'll find that there's high concentration among the underlying stocks. So a country like South Korea, Samsung is in excess of 20% of the index, or Taiwan, TSMC is in excess of 20%, or Petrobras in Brazil. So you've got a lot of concentration within a country basket. The approach that we took here was to say, let's more evenly distribute risk across, starting at the country basket level, the companies in each of these country baskets. And the way that we approach this, you can think of it as a form of risk parity, but rather than using volatility as the risk measure, we use the measure of tail risk. So what we're really trying to do here is balance risk contribution across underlying stocks in each country basket. There is no selection here. We're simply trying to map to, in this index construction, 70% of the market cap exposure in any given country. So if a country has 50 names that cover 70% of the market cap, rather than holding them on a cap-weighted basis, we are constructing the basket using this tail risk contribution measure. Once we've done that, we are then weighting across the countries using the same measure. So rather than looking at backward-looking market cap, we're actually looking at risk contribution. And particularly given that there are, in the 35 countries that we're covering, there's a good amount of exposure to emerging markets. We know that liquidity can be an issue. We know that countries can trade with a certain volatility over time, but then there can be a shock where there's a significant downside event. So what we have found in our research is that using tail risk as opposed to straight volatility is a more efficacious way to distribute risk. So really that's the first layer, create a baseline where we've got risk distribution that's more balanced. The second really is to take into account these factors that we discussed, how indebted is the country, what are the other things that will influence economic growth in terms of economic freedom factors, deficits, how the government is behaving. Now, very importantly, there's a lot of academic literature that simply would suggest that, gosh, if you invest in a country that has higher GDP growth than another country, you shouldn't necessarily expect that to have higher returns. That is actually borne out, and it's very similar to the effect in if you're looking at individual companies. So if you're investing in a company that's growing earnings at 25–30% a year and another company is growing earnings at 5 or 10% a year, if you pay the same price for those two companies, there may be an advantage to holding the faster growth company. But if that company is trading at a multiple that's 2 or 3 times that other company, there may be no excess return. So as Nick said before, a very important part of this is always putting risk into the context of valuation. We're not just trying to buy or weight our portfolio in a way that gives us exposure to higher economic growth looking forward. We're making sure that we are tilting that looks at that forward-looking economic growth related to valuation. And ultimately, the bar to the right here is just a visual representation of the risk allocation across these 35 countries that we're investing in that is far more balanced as an end result once we've run these process layers. And just a very quick look at the current country weights within this strategy versus ACWI-ex-US. You can see that there's much less concentration among the top 10 countries. You can also see that there is a very significant dispersion in terms of the weights relative to cap-weighted. So to point out, there are some very significant country allocation differentials against cap-weighted. We don't, by the way, exclude any countries, so we're not market timing. We're not at any point saying this country will not hold it, but you could have a country that's not particularly attractive based on its principal characteristics. Valuation may well support holding a position in that country that is not insignificant.
Thanks, Ted. You know, one of the real beauties of the ETF world is that you can know what you own, and that kind of transparency is so important for us. And a lot of times we use that transparency to know what we own and view it through size and style boxes, etc. But we really want to know what we own at a more fundamental level, at looking at the kind of characteristics you'd look at as if you were buying a business. And so, you know, if you were looking at a business, purchasing a business, what would you do? You'd look at the balance sheet. And when you look at VIDI, and in this case, comparison to ACWI-X US, you have a favorable government debt to GDP ratio as one of the measures, and then you see the other balance sheet measures there as well. If you were buying a business, you'd look at the income statement for growth. You know, is this business really going to grow? And so when you look at the growth characteristics, the economic growth measures underlying the construction of the Vidant International Equity Index and the VIDI fund, you see those characteristics as well are very favorable. And then workforce productivity, you know, how the people within the business that I'm buying, how do they operate? And this is such a key area, and you see that you want to have a more productive population. And so these are all ways that we look at what we own and how we own it. And one of the keys in this is that we do it with a real valuation discipline. And so we know what we own, we know why we own it, we know what characteristics we're putting into the portfolio, and then we know that we're owning it at a value that we believe is the right valuation for those names. I'll turn it over to, well, there's a couple other slides. Let me just go through these kind of quickly. You saw the improving fiscal characteristics from the other slide, and so here in the same way, government debt to GDP. Let's click on, pick up a little time here. Improving economic growth metrics as well. You see those and how those bear out current account balance to GDP as well. So this really will help us think through the strategy in a different way when we start to understand how we view this, and then it becomes a question of utility of the strategy. So Mark, I thought maybe you could cover some of the aspects of utility. Or
Can I chime in with another question? I'm at the risk of sounding like I'm being difficult. I think you said it's rules based, but it looks a lot like an active strategy. Can you help me parse that a little bit? And I'm not trying to be difficult, but there seems to be a lot of moving parts here that almost make it seem like an active strategy.
Yeah, Ollie, thanks for mentioning that. And sometimes and asking that, we do get that question a good bit about the strategy. And actually, Mark, you want to walk through the slide? And
yeah, so I mean, it is a common question, and there, you know, you're right. There are some active elements embedded within the strategy, and it's a new approach that is really building on what already exists in the marketplace. If you think about the different types of options available to advisors, which this innovation that's happening in this industry is just astounding. As a risk manager, we relish in the fact that there are a growing number of solutions available to serve clients in different ways. When you look at the passive beta, you know, we look at that as market cap weighted. That's been around for a long time. If you want to own the market, it's there for you. It's a great tool to access a very broad-based allocation to any particular area of the market. Smart beta, as we know, has been really coming on. Investors and advisors are really understanding the value of taking a slice of that beta and expressing whether it's volatility, momentum, dividends, anything that you can really target your exposure more closely. I'm going to skip ahead to traditional active, Ollie, to address your question. You know, this is a subjective security selection approach. That, you know, there's a manager or a team of managers who are using fundamental research or some other approach to allocating capital. They're generally picking securities to reflect a view. Now, in that process, you really lack the transparency, and one could argue that perhaps you're not getting the systematic, repeatable approach to it as well. So enter intelligent strategy. You know, we can call it, there are many debates in the industry and with their own walls what to call things, but when you put multiple process layers together and you govern them by transparent and systematic rules, it really does allow for a different space to be created. We're taking an active bet versus your traditional market cap weighted passive beta. However, it's being done so in a very repeatable, understandable way for investors. So it is a new approach in some respects. Now, I also want to take the time to just illustrate what this type of strategy might represent for an advisor as they think about, okay, there's a strategy afoot here. How do I deploy it in the portfolio? And I'll harken back to the, this data that you see on the slide here is pretty common knowledge at this point. Emerging market economies have been growing much faster than developed economies, and the projections are for that to continue. So with that in place, in fact, the global GDP is expected to be 50% contributed by emerging economies by 2022. So it's a continuing trend. So the question is for advisors, how do you allocate? And there are many ways that advisors have taken on to allocating across these two asset classes. And I'll just walk you through three typical approaches. There's a moderate allocation. I think this one is what we would call a home bias portfolio, where an advisor is just taking maybe a little slug of emerging markets and some developed international equities as well to complement and diversify away from their U.S. equity portfolio. That's very typical. A cap-weighted approach is another typical way, where you're just saying, here's the size of the market in each one of these asset classes, I'm going to own it. And what you're owning is essentially the history that has formed those capital markets, that has created the size. And it is it reflects a view, but really a mirror view of what has happened in capital formation over time. Move ahead to GDP contribution, which is a more balanced approach. There's, this is really reflecting what's happening today in terms of these three asset classes' contributions to overall GDP. It does more forward-orient the portfolio to take advantage of some of these trends. And we look at the strategy in VIDIX, in the Vidant International Equity Index. It does provide exposure to developed and emerging markets. It incorporates the principles. It provides another foundation for advisors to build within their portfolios. It takes a risk-balance view where you're getting allocation across 35 countries, and it's got the valuation sensitivity built into it. It's another way to forward posture a portfolio while taking a very sensitive approach to risk on multiple levels.
Thanks, Mark. And yeah, as we look at this, we've talked about our approach to international. So as Ali mentioned earlier, we have developed a U.S. index. And so you think through, well, how do you really apply, we understand the way you apply principles internationally, debt to GDP, and some of the other factors. How do you do that in a U.S. domestic strategy? So the index that we released, the VIUSX, really has some similar construction and some interesting factors as well. Companies with better expense recognition, financial reporting, corporate governance, basically an honesty factor, an honesty and reporting factor. Risk premia factors such as strong governance, high relative quality, positive momentum, and again you see that evaluation theme. Again, we're always looking to get these kind of attributes at the right price. And then the risk balance exposure in this one as well, as Ted expressed, with expected tail loss. So the index has been out, and the ETF that tracks it is coming in the very near future. We're very excited about applying principles to U.S. equity as well. And just to kind of summarize this so we can kick it to question and answer, principles-based investing is really there to offer an investment framework that's rooted in time-tested principles, really looking at long-term investment outcomes, not looking at short-term volatility. We really created the solution to have a long-term risk distribution across countries, across currencies, across companies, and then enhanced exposure to countries, and then in the U.S. strategy, companies, with favorable characteristics for valuation and the other metrics that we discussed. And lastly, doing it in a systematic, rules-based strategy to ensure that we're consistent in the way that we apply these principles. And so we're grateful to get the chance to bring this to you today. We're excited about VIDI and would like to thank the advisors who trusted VIDI as an investment with their clients' funds. And we just want to keep building tools for you all and bringing thoughtful design into these tools for you. So, Ali, thank you for the opportunity to share, and we're glad to take questions.
Thank you, gentlemen. Thank you very much. There was one question I just meant to ask a moment ago, and it's not a bad place to start. Just help me see how this would fit into an overall portfolio, this wouldn't become, for example, the existing fund, the international one, Vidant. How would you integrate that into an overall portfolio if you had a different approach in different realms? Give me a sense of seeing this in the context of a broader whole.
Sure. I'll take that. This is Mark. You know, we view these as core allocations. They can be used in a variety of ways as that core solution. They are absolutely complementary to what already might exist in a portfolio. You know, even a market cap approach is expressing a view, and you know, if you want to diversify that view, a risk-weighted approach and a principles-based approach can add to that and round out a portfolio overall. Another way to use it, if you want to start with that allocation structure that I spoke of earlier, is you can use it as the centerpiece and then express other views around the perimeter of it as a core satellite approach. That's how it was constructed to operate and how we view it.
I mean, just from a personal standpoint, Ali, I mean, I use it as a one and done for international equities for me personally. So it's a really easy way to have exposure to developed and emerging. And, you know, if I want to take opportunistic bets around that, that's fine, but I know that my international exposure is covered with that one instrument.
Right. Now, I'm going to integrate a couple of audience questions right away. There's some really good ones here. When you talk about country weights, are you talking about the company's domicile headquarters, or where the revenue is generated? Can you shed a little light on the indexing methodology in that regard?
Yes, we are talking about where the company is domiciled. Now, the issue with that is, particularly in some of the smaller countries, you can have a very significant amount of concentration, again, in one or a handful of stocks, and very often they're global multinationals. So what we're trying to do is establish exposure to each country's economic footprint. So we want to establish exposure to the stocks that are domiciled there, because we believe that even if they're deriving revenue outside of the home country, the tax environment, the regulatory environment, the trade environment, factors like that ultimately do influence. So they're even if they're multinationals, they're certainly heavily influenced by the country of domicile. But again, based on this risk balancing approach we're using to form these country baskets, by reducing this significant concentration in often these larger global multinational companies, we're getting a pure exposure. So if you were to look at any of our individual country baskets, rather, you'd see that the revenue derivation is more home market oriented than in a traditional cap-weighted country index.
Okay, thank you for that. Just a general question, and this is, you know, in the traffic that I travel in journalistically, there is some concern, certainly a great deal of interest, obviously, in this security Vidant, and I'm sure the follow-up one, VUSE, that's coming up in a couple weeks. Is this too complex? I mean, there's a lot of moving parts here, and in this world of smart beta, enhanced beta, whatever we want to call it, there are a lot of ways to approach this. And this would appear to be a relatively complex one. Can you address that issue of complexity, please? Yeah,
you know, Ali, when you really break down, if we get into a detailed discussion of expected tail loss, yeah, it becomes complex. But when we look at what is the security really doing, really it's tilting towards environments with favorable conditions, and it's buying those at a reasonable valuation. And it's doing it in a way that isn't cap-weighted, but is risk-weighted. So those would be the 3 points to kind of make it simple for clients. One, it's a risk-balanced solution. 2, it tilts towards more favorable environments. And 3, it does it at the right price. So it could be a lot more complicated than that, but for me, that's kind of the way I look at it.
One of the things that's, I think, been very helpful as we've been doing some education on the investment process and the overall strategy really is to look at the characteristics of the resulting portfolio. So, you know, while any strategy that's applying different process layers can appear to have some complexity, at the end of the day, knowing what you own and really having transparency into those characteristics beyond just some stock names, but to say that, as Nick walked through some of the characteristics, that the weighted average indebtedness or government spending as a percent of GDP or deficit as a percent of GDP, the idea is you're improving across all of these metrics as a result of these process layers. And then again saying, okay, so I've got a portfolio where I'm exposed to greater economic growth, better balance sheets, better demographics, higher economic freedom, and that can then be related to the price that you're paying for that portfolio against a set of exposures, i.e. in a cap-weighted index that would have, we would argue, inferior characteristics.
Okay, thank you. There's a question that came in from the audience here about the tradability of the existing security VIDI. It's quite a lot of AUM, as I mentioned at the outset, $545 million. It's nothing to scoff at, and yet it's a little bit thinly traded. I presume a lot of those Ron Blue clients are probably the buy and hold types, which is all good and well, but if you're in the traffic trying to trade the security, what might you offer investors and advisors as advice to help smooth out the trading if you want to transact in the security without facing, gaping bid-ask spreads?
Yeah, I think that's a great question. As we look at this, first of all, our lead market maker is KCG, and then also Merrill Lynch and CS are also market makers. And so we have solid Wall Street presence with that. And yeah, I think it's true, right? Our AUM came about faster than our liquidity. And so it can be a bit thinly traded even though volumes are picking up. But one of the key things to understand is that underneath the security, what you're really buying are approximately 500 companies in 35 countries, and that's mark to market. You can see the NAV, and probably a fair price to look at the security is look at the NAV and then a premium for the construction, because it is very expensive to go into 35 markets, pay the taxes, et cetera, in order to construct the security. So I'd look at it at NAV plus a premium. And the market makers have done a good job for us, holding the bid-ask spread fairly tight, and also going through, and most of the trades that I've seen have gone off above NAV, which is where they should be because of the cost of creation. So far, and I think Ronald Blue and Company clients will continue to put liquidity into this, but we haven't had a lot of issues at all, any that I can think of, with getting fills at a reasonable price and also with a reasonable bid-ask spread. If there have been any issues, I'd like to know about it. We're in constant contact with the market makers, Ollie, so if there's an issue, we always address it with them.
So you think the premise of the question may be slightly off the mark in the sense that it's not as illiquid as this question would suggest, or you're...
No, I think there's building liquidity in the solution, and I think while the liquidity is building in the solution, that the key answer there is that you don't want to get an unfair execution, right? You want to be in the right range of the execution. So even though there hasn't been huge volume, some days there have been very good volumes, but even on the lighter volume days, we're watching all of the executions, because that's one of the things that we don't want to see. Early on, I mean, we had one execution that was out of the market, and we called and right away and talked with the market makers about it, because they their commitment to us is to keep the bid-ask spread tight and to make sure that they're within a range of the NAV that's very reasonable for investors. So that just because the liquidity isn't where some of the larger funds are trading is from a volume perspective doesn't mean that people are getting unfair executions. I think the executions have been very reasonable.
Okay, deep in the nitty-gritty, but totally germane to delivering good returns if you're an advisor. What's the annual turnover looking like, and how are rebalances timed, and how does that add to overall expenses at the end of the day?
Well, we rebal every 6 months, and the turnover is what, about 20%, Ted?
Yeah, it's historically ranged between 20 and 40% on an annual basis. So it's relatively controlled turnover. most of the turnover is not related to security changes, but more weights assigned to individual securities and country allocations that drive that at each rebalance period.
And the country concentrations, or I should say the company concentrations that you're seeing in your underlying country indices, is there a tilt there that's evident in the methodology?
Yes, a significant tilt, and let me clarify my comments before. Really the process we undergo to create a country basket, it's not dissimilar from what you would see at a major traditional index provider. When we go into a country, use an example, Mexico, what we first do is we attempt to cover 70% of that country's market capitalization. So that's a fairly standard cutoff point where you can form a reasonably liquid exposure to a country and get representation of the economic footprint. So if you were to compare within Mexico, to stay with that example, let's call it 40 companies that we own, in that basket, it wouldn't be dissimilar from what you would see. I will not name names, but we all know who the major index providers are. What is different is that the weightings applied within that basket are based on each company's risk contribution to the overall country basket. Now, there are liquidity measures that need to be taken into account, which do factor into the weighting process. But what we have found historically, looking across the 35 countries that we invest in, that by forming these more risk-balanced exposures to the companies underneath, you can improve the risk-reward of the individual country exposure. So that is an important layer where we think we can add value, and that's built into the index construction.
Perfect. Now, here's a good question. There are studies out there that indicate that economic growth and stock performance are not highly correlated, much as you'd think they would be. Some studies suggest they're not. Any thoughts on that and how it all ties back into how you are approaching your allocations in this methodology?
Yeah, I mean, we've looked at that closely because there is quite a bit of literature, as I mentioned before. And, you know, it was very naive, just again, like buying a company, to say that by looking at a single factor, country A is growing faster than country B, therefore country A is superior investment. That would be a very naive approach. And what a lot of the academic literature cites is that just like stocks that are growing earnings quickly often trade at a premium to the market and at times can get overvalued, the same type of environment can occur for countries. So very often it's priced. If you're paying a multiple that's significantly higher to get exposure to a more rapidly growing country, why would you think that there would be an excess return? Other factors, and I'm a little bit surprised that some of the academic literature doesn't delve deeper into this, but to do a simple two-factor regression and say that economic growth does not correlate with stock returns, but you don't look at starting valuation, you don't look at the inflation environment, you don't look at political stability, you don't look at other factors that absolutely will influence capital markets, it seems a little bit one-dimensional. So really, in this approach, what we've tried to say is, of course, you know, just tilting to countries that have better GDP growth, that's not a strategy. And that's why we're looking at many other dimensions of risk and always relating this back to valuation. Very, very important piece of this.
Okay, thank you. That's useful. Now, here's another. I was tending to the nice pointy-headed variety, but very on point in my judgment. How do you measure tail risk in this methodology?
I'll give the conceptual answer. Tail risk. Let me define what it is first. It's attempting to measure what the expected loss is when you are in a left tail event. So there's different analytics and different parameters that can be used to estimate this, but generally, and specifically in this product, I'll define what we're looking at. We're looking at, in the worst 1 out of 20 months, what would we expect to lose? So it's not saying that in 1 out of 20 months, like a value at risk measure, we would not expect to lose more than X. This is actually saying when you're in that 1 month, how much would you expect to lose? The problem and the challenge with measuring tail risk is, as most of us are probably well aware, using traditional distributions, return distributions, a Gaussian distribution that does not accommodate fat tails, does not accommodate the fact that assets don't trade continuously and in a linear way, doesn't really allow you to effectively do that. So I won't go into technical detail here, but just underscore that the process used in this strategy uses distributions that do allow you to model tail risk. And again, as what we have found is if you are assigning weight to either companies or to countries based on expected tail loss, that seems to be a way to very significantly improve exposure and diversification over a cap-weighted approach, but it also seems to improve over traditional, call it a risk parity approach that uses simple volatility and not tail risk.
Yeah, Ollie,
okay.
What he said. No, I'm just kidding. You know, it really is, you know, looking at these 1 in 20 events and evaluating by, you know, the 1 in 20 events and having a risk-balanced approach. So we can go into a very deep dive on it, or we can just at a very surface level understand we're balancing the risk in these securities by looking at them through the lens of 1 in 20 events and what could potentially happen, and it's just a more elegant way to balance risk.
Okay, we're starting to run out of time, and there's so many good questions here. I'm going to try to speed it up just a little bit. If you gentlemen can cooperate with me, that would be wonderful. Our audience would get a lot more out of it. You know, at the risk of making you talk about competition, let's start with some indices. That might be an easier way to get at this. Back testing of data, that's always a bit controversial, but is there any correlation data on these two indices with the ACWI ex-US and also with the S&P 500 so that people could kind of see what comes out of this system at the end of the line, the complexity and all the different variables that you're laying out? How does it stack up?
You know, there's index history for the strategy. So prior to the launch of the product, you've got index history that goes back to 2002. So, you know, those analytics can be run, that the index is available on Bloomberg and some other data sources. We would be happy to provide any index analytics that people would be interested in as a follow-up to the call.
Yeah, that might be appropriate to include that information. Let me, there's some very tangible questions. I mean, one of the questions I have as I look at this, I mean, obviously you kind of hit pay dirt, so to speak, in terms of assets under management with this deal with Ron Blue and Company down in Atlanta. But in some sense, it's putting the cart before the horse. I presume you have other plans besides Ron Blue, and some of the questions coming in, which I think are very real world, you know, where the rubber meets the road. How do you get this security? Are there other? Is it on a lot of platforms? Merrill Lynch was specifically enumerated in one of the questions. What kind of agreements do you have in place that go well beyond this extraordinary tale of $500 million from Ron Blue and Company?
No, Ali, I think that that's a great question, and we are working with several of the large wirehouse platforms going through the diligence process. As you can imagine, Vidant was founded in 2013, and so as we go through and get on the platforms, we've been approved for accredited investors on the Merrill platform, and we'll continue to work through to make the security readily available on platforms, you know, because it's an advisor tool and we want advisors to be able to use it. Most advisors are able to purchase it, but there's still restrictions in some of the wirehouses to use it in wrap type of solutions, et cetera. So those approvals will be forthcoming over the next year. But as you can imagine, all of the wirehouses are very careful and should be with the way they conduct diligence, and we're going through diligence with many of them as quickly as we can. So we really do want broad distribution.
Thank you. Now, I have to say we're almost out of time. I think we have time for a bit of more Q&A here. Slide number 8, I think it was. Was that the one with the Korean Peninsula where you see the south is all lit and the north there's nothing? There was a wonderful film, by the way, on PBS Frontline about North Korea. Apparently, quite a bit of stuff is getting into that country, more than people leaving and going elsewhere. There's all kinds of stuff getting into that country, which is putting cracks in that whole regime. And what I'm getting at here is, one of the things you said to me about your methodology that's interesting, you include a lot more countries than, say, some of the other indices. And MSCI comes to mind, with Korea itself, right? That's a huge issue with their methodology. What kind of, does your methodology afford any sort of way to get into, shall we say, when a value trap becomes deep value all of a sudden? I mean, imagine a day when North Korea becomes, part of the investable universe. Myanmar is almost that, I mean, looking ahead, I mean, that's where you really make outsized returns when expected returns are so very, very high, right? Anything in the methodology that would give people a sort of a longer range optimism about particular constituents in the portfolios?
Well, in the index construction, really one of the first principal filters is to ensure that we can gain exposure to a market where we can construct a diversified basket, where there's adequate liquidity, where it can be traded, where it can be implemented. So the 35 countries that we cover currently represent upwards of 98% of total global market cap across developed and emerging countries, outside of the U.S., of course, because this is not including the U.S. But we do monitor. There's an index committee, of course, that approves any changes and monitors ways to improve the index. We're constantly monitoring countries that are possibly becoming investable, where we can form a diversified basket to get the country exposure. So it is to be expected, I would say, that over time here that countries will be introduced. We just don't ever want to take exposure to a Myanmar. I'll use that as an example. I'm not personally familiar with the exposure of the underlying companies, but I am fairly sure that it would be very hard to form a portfolio of several dozen stocks where you wouldn't have very high concentration in 1, 2, or 3 names.
Yeah, and Ollie, also, we want to tilt towards companies that have these factors of human productivity, and actually we're conducting research towards frontier countries as well. They won't be part of VIDI, but they could be part of another solution that we'll develop, because we do believe in this theme of human productivity. Having grown up in Miami, Florida, and seen what's gone on in Cuba and seen the world pass it by, I almost wish, the world it's harder to keep the world out, and it's harder to prevent the people from knowing what's going on in the world. So when you look at places that today are uninvestable, we do want to look at solutions towards countries that are opening up and have greater human productivity. It's one of our major themes.
Thanks a lot. Thanks for indulging what was a purely abstract question, but you definitely answered it in ways that I found pretty interesting. That's all the time we have. That concludes our expert series webinar on Rethinking the Core, an intelligent approach to risk management. I want to thank you, Nick, and Ted, and Mark, for being my guests, and I want to thank the audience for attending, and also for some really good questions, quite frankly. Again, this presentation, as I said earlier, will be available to all of you in 24 to 48 hours, and you'll receive instructions on how to obtain it in an email. On that note, on behalf of Nick, Ted, and Mark, my guests from Vidant and Lattice Strategies, as well as all my colleagues here at IndexUniverse, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.